Urmi, is it possible to get a clip that I can
We're
send
live.
out on my social media?
We're live.
Sorry.
All right, everybody. Happy New Year. It's January. It's our first live market update with Move Smartly. We have David LaRock joining us today, mortgage broker. As always, Urmi Desai, our editor at Move Smartly. And we're going to go through some of the latest trends I'm seeing on the ground. We're going to change the format of our monthly updates for those of you who follow or listen to us on our podcast. In the past, I would effectively summarize the monthly report that I publish. And while I'll certainly be covering some of the stats and the trends, I'm not going to be covering all of the stories in there, partly because I want to start unpacking them maybe in a little bit more detail on our YouTube channel, so they'll be there. Because during these updates, I was kind of just rushing through some of that information. So I just wanted to spend a little bit more time. So these sessions, we're going to be talking about the statistics, some of the on-the-ground trends. We're going to have Dave join us as often as he can on these monthly updates to talk about the mortgage market. And then, of course, as always, answer all of your questions. So on that note, I'm just going to kick it off. We're going to be chatting about, so here's kind of our overview. We're going to be chatting about the market update, what happened with houses and condos end of December. Going to look at some annual stats and some of the on-the-ground trends. Then we'll bring Dave in to talk about what's going on in the mortgage market. I'm going to show some stats on best and worst appreciating municipalities in the GTA. So in my report, I actually looked at the best and worst performing neighborhoods. Those stats are a little bit misleading sometimes because there are very few sales, but municipalities have quite a few more sales. So this will help us get a better idea of how broad-based this decline was since the first quarter of the year. I'm going to talk about the low sales we're seeing in the GTA, what's driving that, and we'll talk a little bit about listings. So obviously, you can post your questions in the chat, in the discussion for those of you who are watching live on today on YouTube. If you have any specific questions, always feel free. You can set up a meeting with me. You just go to movesmartly.com/meetjohn. And you can sign up for a consultation anytime if you have any more specific questions. So just looking at the market trends for houses in the GTA as we end the year in December, sales were down 46% over last year, very low. We're probably pretty much at a 20-year low in sales right now. So unbelievably kind of sluggish market we're looking at. Listings also down about how much were they down? About 20+% or so. And inventory, the number of homes or active listings on the market was actually almost double last year. And on the surface, that seems like a massive red flag. Oh my God, there are so many listings. It's a bit misleading when we're comparing ourselves to what was effectively the run-up of a bubble, because inventory was unbelievably tight last year. So we're certainly coming up above that, but inventory levels are actually still relatively low compared to historical normal trends. It's just that they were insanely low last year because buyers were buying everything basically. So when we look at kind of the months of inventory, which again is this balance between, well, how many homes were available for sale, and then we divide that by the number of homes that actually sold. And we have just over 2 months of inventory in the low-rise market. That's not a lot of inventory. It's relatively balanced for Toronto. And this has led prices to actually remain flat since July. So prices peaked at just under 1.7 million in February. They dropped to about 1.3-ish million in July and have been basically in kind of cruise control since then. And right now, they were in December, they were down 12% over last year. And even if prices stay flat, as we move to February, that's when we're going to start to see, prices down 20+%, because that February we'll be comparing ourselves to the peak of the market. I'll touch a little bit on the condo market as well. Very similar trends. I mean, condo sales were down 50+%. New listings were down similar, just about 20%. And active listings, again, they were also up. They're up 140% for condos. So of course, way more listings, not as insane as it was last year. Just over 3 months of inventory, so a little bit more inventory in the condo market, but very similar when we look at the price trends. prices have dipped a little bit. The peak was about 840 or so, or about 721, and they've been roughly flat. I mean, they've been trending down very gradually over the past few months. And condo prices are down 2% over last year compared to low-rise houses, which have seen a bigger dip. So those are kind of the trends that sort of ended the year. I mean, quite frankly, the year ended the way it ended was relatively boring. I mean, things didn't change very much since July. The market was pretty calm. There weren't a lot of listings. I mean, from our clients' perspective, that was the most stressful thing. They couldn't find places to look at. And I'm just going to touch briefly on sort of the year-end stats. If you look at some news articles and mentioning kind of the average price for Toronto in 2022, some of the stats are a bit misleading. Sales were actually down 38% last year, but average prices were up 8.6%, which seems crazy. It seems misleading because we all know prices fell in 2022. So the question, of course, well, how can prices be up in 2022? Well, to understand that, we're gonna kind of consider two things. The first thing is, if we look at the average sale price by month in 2021 and 2022, we'd see that the average sale price was actually up year over year for every month, basically up until August. So for the all those months, basically average prices were up year over year. They only started declining on a year over year basis in September. So even though they've been actually declining since February, for those 5 months or so, or 6 months, actually, they were up year over year. It's only in September where prices started to be down year over year. But more important than that, in many ways, is the way the sales occurred in 2022. If we look at how many sales we typically have in a given month as a percentage of the total, and then see what does that look like in 2022, we see a very, very big difference. For example, in March, we typically see about 9% of all the home sales in a given year sell in March. Well, last year in 2022, it was over 14%. So we had this big run up in the first quarter. A disproportionate number of our sales for the entire year were in the first 3 months of the year when prices were the highest. As we moved to the last 3 quarters of the year, sales plummeted. They were very low. So what happens is we are weighting the first quarter of sales a lot more than the last three quarters. And this is one of the reasons why the average price is up. But certainly, if we look at average price sort of at the level it is at today, we're down from the peak. So I would not put much weight into the annual statistics. They're a little bit misleading, and I can't imagine how any economic analyst in the future who's studying our housing market using annual data is going to make any sense of prices rising when interest rates surged. So, but that'll be their problem to sort out. So, Urmi, I don't know if we have any questions about some of the latest trends before we kind of bring Dave on.
Sorry, there we go. I think we're actually I have a question on what you just said around this feeling. I mean, I think most of us feel like boring might be okay right now.
Yeah.
Because we've just been through such a crazy year in 2022. I wonder if you could take us a little bit through what experts are saying. Now, what I'm hearing is 2023 will be a bit of a grind for real estate. So one, what are the general prices declines? I'm hearing a coalescing around like 10%, but not more or less than that. And I believe that's Canada-wide.
Yeah.
And the second thing is we just hit a bunch of headlines, and I think you and David are probably going to get more into this, about a segment of the market that may become more distressed. So so can you talk about this tension between overall, it seems like, Canadians might be better off than we think. There's equity in the market, but that there are certain segments that we're really watching in 2023.
No, that's a great question. So, I mean, the general sentiment and most of the forecasts that I've read from economists are actually not overly pessimistic. Something like 10% more or something like that is what I typically see. I've seen some reports thinking that prices are going to bottom out maybe in the first half of the year, something like that. Certainly, I haven't seen anything that, people are predicting a massive 30% decline or anything like that. So I think most forecasters are basically saying we'll probably see a little bit more downward pressure. We'll probably see lower sales in 2023 as the market adjusts to these high rates. But the thing that has been keeping prices stable, quite frankly, in an environment where sales are at a 20-year low is that listings are actually very low, and we're not seeing a ton of people sell. We're seeing people hold on to their properties, which kind of brings us to this other point that you make. Is there a segment of buyers who are going to be distressed and need to sell? And I think certainly there are. My feeling is it's less likely to be, the average household. Most people who own a home are going to, obviously do whatever they can to keep their home before being forced to sell it. If we see an increase in inventory because of, household or people being over leveraged and not being able to manage, I think it'll probably be more in the condo sector, because there are a lot of people who have investment properties, and those properties were running cash flow negative, meaning the mortgage wasn't, I should say the rent was not enough to cover the mortgage and the carrying costs. And that's going to get worse for an investor who has to renew their mortgage this year, right? So you might see some of them potentially just moving on, because it's going to be a hard pill to swallow to say, okay, I'm putting $1,500 a month out of my own pocket to carry this condo, especially if you don't expect prices to, accelerate too much over the next 2-3 years, right? So we might see more, but again, this is why it's so impossible to predict and why we keep an eye on some of these trends. And I touched on some of these issues in the report, and I'll probably try to unpack them on our YouTube channel about some of the dynamics we're going to be keeping an eye on over the next 12 months.
Great. But in general, these were some of the concerns going into the new year. The data is not showing material, evidence of this. I'm guessing maybe this is something you and David will be discussing next, in terms of us really starting to see these listings starting to hit the market.
Yeah, no, we haven't seen that yet. We haven't seen much. I mean, certainly we're hearing of distress, right? Like people's budgets are very difficult. People are having a hard time coping. People are getting stressed, but we haven't seen people rush to sell. And, it doesn't mean it's not going to happen. Like people, and I wrote a Twitter thread about it, maybe I'll do a video about it, but people will hang on to the last minute. They'll take on more debt to pay their current debt, and they'll just keep doing that before taking a loss. And that can only go on for so long, right? And I'm sure, we can talk about Dave, but I think the challenges in the market are if rates stay high for longer. In some ways, it's like 2024 might be a bigger problem if rates are still this high, quite frankly, more so than 2023.
Okay, great. We're getting some great questions coming in. They're a bit more specific, so I'm going to hold them to a little bit later and continue on with your chat with Dave.
Awesome. All right. So let's go back to our slides. So I'm going to bring in David LaRocque. For those of you who don't know, Dave writes, contributes his articles on movesmartly.com. And you know what? I'm going to actually stop the sharing, even though I have a few slides here for you. Well, since we're chatting, we're going to make it a little bit easier to follow. Dave shares his great analysis, for those of you who don't know, on Move Smartly. He had a great roundup of what he's expecting for 2023. So I thought I'd bring him on to chat a little bit about the things that he's seeing. Thanks so much for joining us, Dave.
Thanks for having me, John.
All right, so let's just kick off. I mean, one of the things you mentioned in your article is that you think inflation is going to be stickier than some people are expecting. So maybe kind of unpack what you mean and why that matters to interest rates and mortgage rates.
Sure. Well, it matters because the central bankers have egg on their face from having predicted that inflation would come back down quite quickly, and that didn't happen. So they lost credibility, and their nightmare scenario is when inflation expectations become what's called unmoored. And that means that people don't expect inflation to come back down anymore. And they start behaving differently. In other words, if you think prices are going to be significantly higher a year from now, you accelerate purchases today because everything is going to be more expensive later, and that creates more demand and that fuels more inflation. And most importantly, people start negotiating for more substantial raises because they expect that inflation will erode a larger percentage of their purchasing power. And that's when you get into the dreaded wage price spiral, where fear of higher prices pushes up wage costs, and then higher wage costs actually drive prices higher in a spiral that that can continue and be difficult for bankers, central bankers, to rein in. So that's really that is the central bankers' worst case scenario. They have been adamant that they're going to keep rates high, even though it will inflict pain on the economy and on people, because they have to bring inflation down, because they have to make sure that inflation expectations moderate. And right now, the data they see in their consumer and business surveys says that inflation expectations are elevated for the next year or two, but they are very much contained beyond that. And that gives them a lot of reassurance that if they act forcefully now, that they can keep inflation expectations from becoming unmoored. But if there's any sign that that's happening, then they'll raise rates however high they have to, consequences be damned. And that's really the backdrop that we find ourselves in. Now, back to your question, John, of why I think inflation will be sticky. Average wages have gone up by more than 5% year over year for 7 straight months. And wage costs are pervasive. They run throughout the economy. They are most businesses' largest single cost. So when wage costs are going up by 5%, it's hard to see inflation coming down much below that. We can go from 6.8 down to 5.5, or maybe even get to 5, but we're not getting anywhere near 2% when wage growth is averaging 5% plus, at least not sustainably. I just can't see that happening, again, because labor costs are so pervasive. But also, when people say, well, people, wages, employees have to take less. Well, from an employee perspective, if inflation's been higher than 5% the whole time that wages have been growing by that much, the average worker hasn't benefited. They're actually worse off. Their purchasing power has been shrinking despite the fact their wages have been growing by that rate. So if you stopped everything today, workers wouldn't be happy with 5% because inflation is running well above that, and they would rightfully want more. The other side of the equation is, depending on what the supply-demand balance of the labor market looks like, employees may just have to live with lower wages, but employees have a lot of leverage right now. We have record levels of retirements. That means the participation rate is dropping, the number of Canadians who are actively engaged in the workforce, and we have higher absenteeism because of a bad flu season, higher COVID infection rates, and there are long-term factors to suggest the supply of labor. There's going to continue to be pressure on the supply of labor, which is going to give employees more leverage than they've typically had. So employees want to use that leverage to keep their heads above water, and justifiably so, in my opinion. But average wages being 5% plus 7 months in a row, for as long as that continues and anywhere near that trend, I don't see inflation falling sustainably below 5%, and that's the biggest reason why I think it will prove stickier than many hope.
Wow. So, and I guess that kind of leads nicely into the next kind of comment or prediction you made, which was that the Bank of Canada isn't going to pivot in 2023. So maybe unpack for those who are not following what pivot means. Maybe unpack what that means and what that means to interest rates.
Sure. So a pivot would have essentially mean that the Bank of Canada had moved from a tightening phase into a cutting phase. And typically, the average length of time between the Bank of Canada's last rate hike and its first rate cut is 14 months. Now, the market thinks the Bank of Canada is going to hike one more time in January and may hike again in March. So the clock on when that 14-month starts may not even have started yet. Some assume it has, but I don't think that's a given. So number one, if we take the average of 14 months and we get another hike in January, we're already into 2024. That's number one. Number two, when the Bank of Canada, sorry, John, I've lost my train of thought.
The pivot.
Thank you. Yeah.
No pivot.
Yeah. So thank you. Some argue that because debt levels are so high now that it'll magnify the impact of the increases the Bank of Canada has already enacted, and the BOC, and that might shorten the length of time needed. So if the average is 14 months, some people are hoping that that maybe it'll take less time because high debt levels will magnify the impact of the rate hikes we've seen thus far and shorten the amount of time necessary to achieve the slowing impact of those rate hikes on the economy. And I accept that. I think that is a valid point. But inflation is much higher than it typically has been. So 14-month that 14-month gap between the last hike and the first cut has typically been when inflation is much lower than it is now. And again, the point I made about wages causing inflation to be much stickier, I think those things, when I balance the factors, lead me to believe that the Bank of Canada is going to wait longer. And again, they're so determined, having gotten it wrong at the end of the pandemic, that to get it right this time and to prevent inflation expectations from becoming unmoored. So I think they definitely have an over-tightening bias, and they're going to err on the side of keeping rates high for too long rather than cutting too soon. Another interesting anecdotal point to make is they are students of history, and in the late 70s, early 80s, when inflation really took off, back then, central bankers cut rates too soon. Inflation surged again after dropping. It actually peaked the second time at a higher level than the first peak. And again, there's probably a lesson there that would give them tilt them in the direction of over tightening this time as well.
So I guess one thing that stands out is, and one thing that I think is concerning is, if inflation is going to stay high for long, if they're not changing rates anytime soon, my concern is a little bit more with, like I said, the 2024 market versus the 2023 market. Again, I think, and again, just my anecdotal experience. I mean, households are going to hang on. They can hang on for a certain amount of time, especially investors who are over leveraged. But at some point, things start breaking, right? Like, having mortgage rates at 5%, we can do that for a year or a year and a half. Can we do that for 3 years? And I don't know. And I think that's where, is the red flag in the market, 2024, is that the market where we should be more concerned about, more so than 2023? Because even the Bank of Canada's modeling says that it takes 18 to 24 months for interest rates to work their way through our economy, right? It's not instant. So, is that the period where we should be more concerned about, I'm wondering?
Absolutely, John. The longer rates stay higher, the more strain it'll put on people. And the first rate hike happened last March. So we're not even 12 months from the first of the hikes that occurred. So we really don't have a sense yet for what the true impact of all of this tightening will be. We know that it's a lot of rate cuts. It's the most rapid series of rate cuts in modern history in 4 decades, almost 5 decades. We know that with record high levels of household and government debt, that will magnify the impact of those hikes. So there's no question there's a lot of headwind impact coming for the economy that we can't fully quantify because there is no precedent for it, no recent precedent, certainly not with debt levels where they're at. Absolutely, the longer rates stay high, the more stress it'll put on the economy. In answer to the question that you guys were discussing just before I jumped on, for my 2 cents, I would say in terms of where I see the most immediate vulnerability in the market, it's with borrowers who bought new construction properties a few years ago, who did so when rates were in the 1.5% to 2% range, who are now trying to get financing at 5% plus and can't. I mean, there are anecdotally, there are lots of ads showing up in my Twitter feed now of people saying, I will sell this property on assignment and give up my deposit if you'll take it off my hands. And I think in terms of where things will break first, John, I think that to me would I would put a pin in that one.
Do you think more so in the pre-construction condo space or the low-rise space, or both?
I think anybody who committed to buy a property 2 or 3 years ago is going to feel the strain.
Yes.
So
Yeah.
more broadly, I would say both would be areas of concern. But my sense is condos, because I think there were people who for a decade or more did very well putting deposits down on condos that they never intended to close on, and sold them on assignment for a tidy profit. And ultimately, I think that the longer excesses are allowed to continue, the more extreme they get, and condos are typically cheaper than low rise. So I think that you could get more chips on the table, so to speak, with a lower cost product, and that would be condos. So I would say that would be the leading edge for me. That would be my assessment.
Yeah, that's a good point. And while a lot of the people completing this year maybe bought in 2017 or 2018, there are a bunch who bought more recently, like late in the development cycle, in 3 years ago. And yeah, they could very well be impacted. So that's a great point. We're going to wrap up with one last question I want to ask you about the mortgage stress test. And, you made a prediction on your blog post that it's not changing anytime soon. So maybe kind of unpack that, and unpack our bank regulator suggested maybe it will, but not in the way most people want it to. So maybe if you can unpack kind of what you're seeing and thinking in that front.
Sure. Well, a lot of people are hoping that the Bank of Canada will reduce or drop the stress test, and that hope is frankly founded on sound logic. When the stress test was first introduced, the justification was that we were at ultra low rates, and the regulator wanted to ensure that borrowers could afford to renew at much higher rates at renewal, because back then, rates bottomed at 1.5. So stress testing people at 5% when rates were at 1.5 was a way of ensuring that if rates went sharply higher, that our economy could withstand it, and that borrowers wouldn't start imploding like happened in the U.S. in 2008, 2009. They have much looser underwriting guidelines, and there were other reasons why the U.S. market blew up, and quite frankly, ours didn't and hasn't since. But the stress test was a way of a conservative way of ensuring that borrowers could afford for rates to go significantly higher. Fast forward to today, I think that does certainly gives me some comfort that variable rate borrowers and people renewing today were stress tested at rates about where they are now. And of course, there were exceptions made, and some will argue that some lenders, certainly the larger lenders, had offered a bit more flexibility than maybe they should have. But on a macro scale, I think the stress test did its job. Anyway, the argument is, hey, rates have gone way up. We needed the stress test when rates were at ultra lows. Now that rates are back at 25-year average levels, why do we need to be adding 2% to the rate? It did its job when rates were ultra low. Now they're not ultra low, so we should peel it back. And again, I think that's a fair point, and it's founded in logic. The flip side is our banking regulator knows that we've got an inflation problem, and the Bank of Canada is trying to create headwinds for the market, for the economy, to try to bring inflation back under control. Housing and lending are the leading edge of the wedge. They are the most interest rate sensitive parts of the economy. And if at the same time the BOC had to crank rates up, the banking regulator repealed the stress test and increased everyone's affordability by 20%, they would be undermining the bank's efforts and completely counteracting all of the effects of the higher of the rate hikes we've seen thus far. Anyone wishing for a stress test should consider this. Right now, you can borrow at 5% and you're stress tested at 7%. If we got rid of the stress test and everybody could afford 20% more, you might not have a stress test, but you might be qualified at a contract rate on your mortgage of 7%, because the Bank of Canada would have to keep hiking rates to offset the stimulus that would occur if OSFI repealed its stress test. So be careful what you wish for. Long story short, I think the day will come when OSFI will take a good look at the stress test and either cut it back or possibly, depending on what happens in the housing market, repeal it altogether. They do have that card to play at some point in the future, but I can't see that happening at a time when the BOC is very concerned about inflation. I mean, the banking regulator is supposed to preserve the stability of the banking system, and too much inflation is bad for the banking system. So I think their concerns are aligned, and it would completely counteract all of what the BOC has done to try to bring inflation back down.
Interesting. Well, that's and to unpack for everybody, OSFI, I think, is the banking regulator that they mentioned. They regulate sort of the banking system, and they basically are the ones that make the decision on the stress test, but specifically for uninsured mortgages, correct? Like if you have 20% more down. Or are they in control of insured mortgages too, with people with less than 20% down?
So OSFI regulates the banks, and the insured mortgages are, because the insured mortgages are guaranteed by the federal government, that would be handled by the Ministry of Finance, but they definitely work
Speak to each other.
hand, and
Yeah,
there wouldn't be any decision made on the insured side that OSFI hadn't signed off on. To your point, by the way, John, OSFI issued an announcement this morning, and it said that near-term risks mean that we may need to consider complementary measures to mitigate the current elevated risks in the market. And so to your point, if OSFI does make a change from their news release today, it sounds like they might tighten more, not loosen. So
yeah, I saw that, and I thought it was an interesting announcement, because, in a market where things are so sluggish, you don't expect them to tighten credit. That's obviously going to, in some ways, make the market, when you make it harder to get a mortgage, obviously that puts more downward pressure on sales, on demand, and potential on prices. So it was interesting to see them suggest that they might do something like that.
I'd be surprised, John. The market already has a lot of headwinds right now. Our regional real estate markets already have a lot of headwinds to deal with. Unless they were really concerned about stability risks, I could see them tightening up on some of the exceptions that are being made by, for example, the major banks, because they typically have a bit more latitude, because they lend with deposits and they don't have to securitize, and that means that they generally are the loosest as far as their underwriting policy goes. But this may be a case of, well, everybody was hoping we'd loosen, so now we'll scare everyone to thinking we might tighten, and then if we do nothing, everybody breathes a sigh of relief rather than complains that we didn't loosen.
That's so funny. Awesome, Dave. That was super helpful. Urmi, do we have any questions? Yeah.
Yes. Before we let go of Dave, we have a lot of good questions coming in on the chat. One from Austin. How is a prolonged period of higher interest rates going to affect pre-construction releases and prices? So I presume this is now looking down the road.
So, I mean, it's gonna keep them low. I mean, and that's what we're seeing today. I mean, sales are low for pre-construction. Again, part of it is people don't have, like, a lot of people were buying pre-construction, were borrowing off of their HELOCs, so their home equity line of credits, on their home for their deposits for their condos. Sure, some investors had capital and cash, but a lot of people borrowed. It's a lot more expensive to borrow on your HELOC today for your deposits. So sales are going to remain very low for pre-construction condos. And quite frankly, I think the challenge if you're investing in pre-con is that if resale prices are not appreciating, well, why am I paying a 30 to 35% premium for a pre-construction condo, right? Like, that only in theory worked in the past because the resale market was going up, right? So I think it's going to be a pretty sluggish next couple of years for pre-construction. I don't know if you had anything to add, Dave.
Well, the only thing I'd add is that developers are pulling their projects or suspending them, because I think they're concerned about what kind of demand is going to be there for what they're offering the market at much higher rates, and that will reduce the potential new supply coming onto the market at a time where we've got a problem with not enough supply. So, or at least a lot of, some argue that's the case. So what do you think, John? Do you think, I've anecdotally heard developers are suspending projects or pulling them all together. What are you hearing?
Yeah, no, 100% they are. I mean, Urban Nation came out, I think they said they're shelving 10,000 units, but a lot of this is just the pre-construction space is facing the same challenge as the resale spaces, which is like demand's down. There's less money. So they're not, part of the narrative is, oh, they're greedy developers, they're hoarding land. Well, not, I mean, they're businesses. They have to, right. They don't want to launch if they're not going to sell their products, right? And so they're not launching a certain number of units. They're holding some units back because they can't achieve the prices or the sales they want in the timeline they need. That's the other thing. You can't take 5 years to sell the project. You have to sell it within a certain amount of time so you can start building. So yeah, I think it's going to be a tough market.
Great. Final question for Dave while we have him from Keaton. Dave, I love your lines editing over at moosnartley.com. They're always fun to see. This question from Keaton's around employment. And recently we just saw Canada Post above expected employment numbers. And that caused you to say, this is going to be a year in which good news sometimes looks like bad news. So one, I think you touched on higher, good jobs numbers sometimes means, again, wage inflation and other things. And Keaton now asks, when would unemployment generally start to tick up in a cycle like this? So we haven't seen that so far. I know this is a very different environment than the early 80s, but is there a time horizon or leading indicator to look at?
Sure, that's a great question. The Bank of Canada has said that it certainly expects that unemployment will rise as a result of its monetary policy tightening. As far as when we'll see that, it's hard to say. I mean, as John and I discussed, it takes 18 to 24 months for the rate hikes to exert their full bite on the economy, which means that the first rate hike last March won't really be baked into the economy until the spring of 2024. So the timing of how long it'll take is it's tough to say. I mean, maybe companies will cut back sooner because we've had a ton of rate hikes, so they'll do it preemptively. It's not clear right now. There's a lot of unfilled job postings. So the first thing that'll happen is that the ratio of postings to available workers will normalize. And when that happens, there's no change in the unemployment rate. It just means that instead of having too much demand for too little supply and demand come back into balance. It's only beyond that point, when supply continues to fall and demand is unchanged, that the unemployment rate rises, because in that, and again, economists can give you a very complicated answer, but in that instance, we get to a scenario where there are more people looking for work than there are jobs to employ them. But again, we're on the other side right now of that equation. We've got too many postings and not enough workers to fill them. So I think it'll take time. I don't think it's anything immediate. The debate now in the economics community is whether we will see a significant rise in unemployment to bring inflation back down to the Bank of Canada's satisfaction. A lot of economists argue that we're not going to need to see 10% employment like we often see in recessions, and they make a lot of good points. I read those arguments now. I haven't read enough of them to be able to articulate my own view. It's sort of an unfolding debate that I'm following with a lot of interest, but I think I will. As hard as any predictions are, I think I'll hold off on any predictions about that one until I've read more of what the economics community has to say.
Great, we'll keep tracking that at Move Smart Realty. Thanks, Dave.
Awesome, thank you so much, Dave.
Thanks,
for
guys.
having. All right, that was great discussion. Let's go to the next few sections. I'm gonna go through these. We have about 20 minutes left. So in my report, I kind of chatted a little bit, or I showed some stats on best and worst performing neighborhoods. Today, I'm going to just chat briefly about the best and worst performing municipalities in the GTA. So the GTA is 5 regions. It's the City of Toronto, and it's our 4 suburban regions. So Durham region, Peel, York, and Durham. And if we look at sort of how prices and what I did, okay, normally we look at, when we look at the best and worst performers, we compare 2022 to 2021. I mean, that's normally what we would do in a typical year to see how prices changed. But as I discussed earlier, we can't really do that because the stats are misleading because prices fell for much of 2022. It wasn't really captured in the annual statistics. So what I wanted to do and what I did here was I looked at, okay, what were the average prices in each of these municipalities during the first quarter of the year for the first 3 months? And then what did they look like in the last 2 quarters, so the second half? And I did the last 2 quarters because there were fewer sales, so it helps to have a little bit more volume, but also prices were largely flat over the last 6 months. So this is looking at sort of, again, the change from the first quarter to the end of the year. And if we look at that, what we see is across all the municipalities, pretty much most of the regions were down more than 20%. The areas with the biggest drop were Brock, Scugog, and Stouffville. Again, these are areas that are probably among the furthest from the city of Toronto, sort of the outskirts of the GTA. And the areas that kind of didn't drop quite as much as the other areas were Richmond Hill, Markham, and Oakville. It's tough to say what's behind sort of some of these slight differences, but even those areas, Markham and Oakville were still down, between 17 and 18%, and Richmond Hill was just below that. So that's when we look at the low-rise housing market. When we look at the condominium market, we see a little bit of a difference. I mean, across the board, most regions were down, I'd say around 15-ish or slightly more percent than that. The areas that didn't see the biggest decline, that kind of performed the best, if we want to think about it like that, were, again, Oakville, Toronto, Aurora, and Stouffville. I mean, Stouffville doesn't have a lot of sales, but the few that they had didn't drop very much. But these areas, prices declined anywhere from around, 7 to 8 to 9%, whereas most of the other regions in the GTA saw prices down pretty much 15 to 17% or so. Brampton and Newmarket saw the biggest declines in prices. So I'm going to move on to chat a little bit about the really, really sluggish sales we're seeing, understand what's happening, and kind of compare that to historical levels. So, in our sales meeting, we talked about sort of the biggest demand right now is for homes under 900,000. And a question came up, why 900,000? What do the numbers look like at 900? So imagine you're buying a home as a first-time buyer and you're looking for a family home and you've saved up $100,000. You basically need, of course, a mortgage of $800,000 to buy a home. Well, what is the mortgage payment on $800,000? It's just under $5,000 a month, which is an unbelievably high number. Especially considering this does not include property taxes, heat, hydro, insurance, so we're talking roughly $6,000 a month in housing costs, which is very high. Of course, most households can't afford that. I mean, you'd have to be making pretty much over $200,000 a year to afford that. And this is why the market is so sluggish, because with high rates the way they are, I mean, prices are still high, and rates have made it even less affordable. I mean, when rates were sort of at more of their historical levels, even in the threes, that mortgage payment, instead of being $5,000, would be $3,700 or $3,800, which is still high, but obviously that extra $1,200, $1,300 a month makes a very, very big difference. And this is one of the challenges that a lot of, especially younger buyers, are facing in this market, because if we look at everything that has, how hard or how easy is it to get a $900,000 house? It's very hard. I mean, the GTA in the last 6 months of the year had just under 29,000 total home sales. Of those, only 3,200 were 3-bedroom low-rise homes, so family type homes. And yes, there are condo townhomes. If you're buying a condo townhome, your budget needs to be lower because condo fees lower your qualifying amount. So I kind of focused on the low-rise home, which is the most typical. So again, 3,000 sales out of 29,000. So it's very, very hard to get into this market if you're looking for that, starter sort of first-time home for a family with 3 bedrooms. And this is, again, the affordability is the reason why sales are so low. So if we look at sales in 2022, and what they look like if we compare it, back to over the past 20 years. The last time sales were this low were in 2008, and that was during the financial crisis, and before that 2002, which is 20 years ago. And it's worth remembering that our sales in 2022 included this massive surge in demand and sales in the first quarter. And this is partly why some economists think sales volumes will actually be lower in 2023, because we're not going to have that massive acceleration, right? We're going to be at these 50-year lows, or 50-year lows, 20-plus-year lows for probably most of the year. And it's this soft sales that we're seeing on the ground. But again, as I mentioned earlier, the thing that has kept the market relatively balanced so far is listings are tight. And of course, the biggest question is, will listings volumes pick up? We don't know. I mean, it's worth noting that the first couple of months of the year tends to be the lowest for listings and the tightest market. So buyers that are active will probably still find it very competitive over the next 2-3 months. I mean, I don't think we're going to see a material increase in listings volumes. I think most households, most investors will hang on. If, as I said, we talk about with David, if rates stay higher, maybe in the latter half of this year, as more and more people renew, we might see an increase. But again, I think it's more likely to be kind of in the condo space, because most people, if they're over leveraged and have lots of properties, are going to sell their investment properties before they sell their home. So that's kind of my 2 cents. That's kind of what I'm seeing on the ground right now in terms of the latest trends. Urmi, I don't know if we have any other questions.
Yes, we first a comment that's interesting from Keaton, just touching on what you just said. A third bedroom is not just 100,000 K up from a 2-bedroom, it's a 250 K as you're changing home type. So
yeah, exactly.
It's a massive squeeze, says Keaton. And now we're going to get to some more specific questions people have. This is one that comes up and is a good one. As the market changes, what should consumers do? So Joe asks, we have a duplex, which will be coming vacant soon. That is just one unit. So one unit is going to be coming vacant. Do you think it's better to just leave it empty and then sell it? Or should we put a tenant in it and then try to sell it? I think you covered this in one of our other features, the situation. So Joe, you can look for that on our channel. But
this is a bit different though, because this is a duplex, right? In our discussion on our Q&A, the situation, it was a family home. So the whole home, either sell it vacant. Right. So I guess the key question for that is, is the unit that's going to be vacant sometimes you have duplexes where they have one unit that is ideal for an owner occupier, and then the second one that is good for a rental. So if the unit that's vacating might be a good fit for an owner occupier who wants some rental income, then I would probably leave it empty and stage it and rent it that way and sell it that way. That way someone can buy it and move into sort of that potentially bigger unit, right? If it's not, then you're basically selling an investment property, and you may want to rent it. It's it's a tougher markets to sell investment properties, but again, I think you'd have to look at it specifically to figure out what the best strategy is and what the best way to market it is, because it's a lot harder to sell like a duplex or triplex that's tenanted today than an end user home, because there are fewer investors out there with capital looking to buy.
Right. Thanks. And in our show notes, you can see if you do have these more specific situations, you can get in touch with John and Realosophy to share more details and get more information on your situation. I think that's all I'm seeing for questions. Another lively one. Thank you, everyone, for joining us. And John, I'll leave it to you for any closing thoughts. What a month. Use the word boring.
Well, I mean, the second half of the year in Toronto's housing market was relatively boring. I mean, there's nothing changing. I felt like every month, yes, sales are at a 20-year low. Yes, prices are flat. There wasn't much going on in terms of activity or shifts. It was pretty steady, and we'll have to see what this year brings. Again, it's very hard to predict. A lot of it's going to depend on listings volumes, quite frankly.
Yeah, my observation so far at movesmartly.com is that the data is remaining pretty flat, but or it's not changing as much. But the storylines are anything but boring. We have touched on so many of them now, so we're going to keep tracking these things. A lot of people are asking about leading indicators, and the funny thing is, we're all kind of in a wait and see pattern. We're hearing anecdotal information first, and not seeing it in the data yet. So this is, something that we'll have to keep tracking closely. Is my takeaway.
Yeah, definitely. And something I think we're going to try to keep on top of, both in these discussions and then in our discussions that we have with Steve, some of the things that we see in the ground. Because again, when we look back at last year, we were talking about the first red flags on the ground in end of February. They made it into my March report back when it was the peak, because
yes, before it was in the data.
Before it was in the data. So it is important to kind of keep an eye out for some of these potential leading indicators, because the market can turn on a dime, and that's the hard part. If we think about last year, 2022, the market just shifted unbelievably quickly from exuberant to pessimistic, right? You can't predict these things. You can only just keep an eye out for them and see how they're evolving over time.
And adjust your own planning accordingly.
Absolutely.
Okay, well, thank you, everyone. Thanks to
everyone.
all our viewers and listeners for another great session. John spoke about the other feature with Steve. That's on our Move Smartly channel, the roundtable, where we speak to Steve in Vancouver as well. And in the meantime, please keep in touch with us. You can reach me at editor@movesmartly.com, and we look forward to the next update, having you join us live again.
Thanks, everyone.